wherever you may find yourself in the world. My name is Mark Muller. I'm a director at Sanlam Private Wealth, and we want to welcome you to another webinar that we are hosting. We have attendees from 9 different countries today, so we are very pleased to welcome you all. A particular word of welcome to our colleagues and clients all over Africa. So thank you very much for joining us. For those of you who have attended our series of webinars that we've had since March of this year, you'll be no stranger to Peter. I know that we work closely with Peter and with Hannah. This morning we've got an exciting presentation lined up, or 2 exciting presentations lined up by Peter. Peter and Hannah are in our office in London, and so we're very pleased to welcome them this morning. Peter and Hannah, I'm going to do a quick introduction to you, and then I'm going to hand over to you if you're happy and ready to take it away from there. So. For those of you, again, who have attended before, you'll know that Peter's introduction takes all of about 20 minutes with all the accolades that Peter has had over the last while, but I'll summarize it very quickly. Peter is Sanlam's Global Head of Equities. He has been so since 2012. He's based in London, as I mentioned, and he currently manages assets to the value of 1.2 billion. That's gone up a little bit. Peter can update us on that. His responsibilities include the design, management, and implementation of Sanlam's global equity client offering. Peter has received a number of awards, most recently an Outstanding Achievement Award at the City of London Wealth Management Awards 2018, where he was commended for his passion for investment and commitment to his clients. And then with Peter is Hannah, who is a global equity investment analyst. Hannah is a core member of the global high quality team. Hannah acts as a dedicated product specialist and leads all aspects of areas surrounding the execution of the investment strategy on the global equity team. Hannah was awarded Investment Week's Young Investment Woman of the Year in 2018, and Hannah joined Sanlam in September of 2015, having obtained both an honours degree and master's degree at Trinity College of Music. And Hannah was on her way to becoming the female version of Kenny G, and Peter then snapped her into a career of investment. So Peter, with that short introduction, I hand over to you, and thank you very much for joining us again.
Hi Mike, thanks very much for the introduction, and just wanted to say from our perspective, it's absolutely wonderful to be here today, and to have such a wonderful turnout from so many places all over the world. I know it's been it's been a really challenging year from us to be able to not go out and visit all of our clients and everything. So it's a part of what we do that we really treasure. So to have everybody signed in from all over the place today is really fantastic. So also thank you very much to Mark and his team for maintaining all those fantastic relationships and organising this today. So we have a really great presentation lined up for you. We're going to give a bit of an overview of what we've been doing over the last few months in our core global high quality strategy, and then move on to talk about a really exciting new initiative that we've launched very recently, which is our Sharia compliant version of our strategy. And there's a lot of overlap between them. We've made a lot of changes to the portfolio in recent times, given all of the market volatility. We've had some fantastic moves from our names, and our strategy has now hit all-time highs in US dollar terms. So it's really fantastic news for our investors in that point. So with that in mind, I'm going to just share my screen with you now.
Hannah, if I may, just from a housekeeping perspective, just to keep everyone informed, the presentation there's going to be 2 presentations, essentially. One's on the high quality fund, just a recap, just a short recap, and then about 20 minutes or so on the Sharia compliant fund. And then we will have an opportunity for Q&A at the end. Apologies, I should have said that up front. You're welcome to send the questions through the chat. Otherwise, if you want to email me afterwards, you're welcome to do so as well. Apologies, Hannah.
No, not a problem at all. So we're really delighted that we actually reconned all our numbers yesterday, and we've now hit $2 billion under our global high quality strategy, which we're very, very proud to be able to have built up a wonderful investor base and support over the years. As Mark said, Peter launched the strategy here at Sanlam in 2012, but it's a long-running strategy, and we've got over 13 years of performance now behind it. And whether that 2 billion is split under the institutional funds such as our global high quality fund, or whether it's in segregated mandates, is all really important to remember, and that includes the Sharia portfolio that we'll be going into later, that no matter how you access the strategy, it's Peter's same core global high quality investment philosophy and process that underpins all of it and is spread out across that whole strategy. So we're very pleased though to have reached that $2 billion, and thank you to all of those for your support as well thus far on this journey. But we've had a great year in the sense that we've now won 14 awards, including the Investors' Choice Awards on the institutional side, Private Asset Managers Awards, and of course Peter again for his consecutive year of FE Alpha Manager ratings, which puts him in the top 10% of all managers across all asset classes in the UK across his long-term performance, which is what we really want to focus on here with that time horizon also across our strategy. And we've got the same team of 6 still sat here in London. We've got a really fantastic team, very stable team. We've all, if we haven't been here from the very start, we've joined along the way. We're all doing really well through COVID and the relative disruption. Lots of things going on here with the UK and everything, just back out of our second lockdown. But, the team stayed really strong. Peter launched the team, as we said, in September 2012. He's had William there, our deputy fund manager, from day one with him. And, Louis, Nick and Shiraz and I joined along the way. We've got our team is still set up in the same way, generalist analysts. It keeps them interested. It allows for really good read across between different sectors and so forth. So if Louis is looking at heart valve technology with Edwards Life Sciences, which is a new position we've brought in to our Sharia strategy recently, William is looking at Medtronic, which is the world's most diversified medical equipment company. So we've got that really good read across there, such as, Peter with British American Tobacco and Louis covering Altria as well. So it keeps everybody interested. It allows for devil's advocates across all of our stocks. And what's really important to keep noting, across all these times of volatility, our process and the strategy, that how we look at our stocks, how we look at our universe has not changed across the course of everything that's gone on over the past 12, 13 years. Peter, I don't know if you want to talk about performance.
Thank you very much, Hannah, for that introduction. I also want to mention how we, and this will come out in the presentation, how we're also using the resources of our emerging market team as well as our UK team to enhance the ability for us to cover stocks in more and more detail going forward. So when you look at the snapshot of where we are year to date, it does hide a lot of different factors, a lot of different aspects of this market that's been in play. If I was to give you some statistics around concentration over the last 3 years, which I've highlighted in my monthly commentary yesterday, if you look at the market over 3 years, 85% of the market's total return globally is from the US. Other statistics, there's a couple of big technology and related names that 6 of them, the likes of Amazon, Apple, Alphabet, Microsoft, Tesla, these names collectively, only 6 names contributed more than 1/3 of the global equity market's total return over 3 years. And what I'm trying to say is that this is a very, very concentrated market. It's a market where large parts outside of the US don't participate in the market. But having said that, we've actually found some very good ideas over the last 3 years, which have contributed to our report, to our returns. We are significantly ahead of the market over 7 years and against the average peer out there significantly. And more importantly, also, if you look at the very long term, as Hannah said, very important for us, we've reached new all-time highs in our strategy. The compounding effect of outperformance is showing up also in the difference between ourselves, the index, and the average global equity fund. And again, very, very importantly, when we look at our portfolio today and we look at that compound return of 8.5%, which translated over 12 years to 180% total return in dollars. We're very comfortable that we followed our process during this very volatile period. We've made some excellent new investments. Some of them actually ended up getting to where we wanted to be very quickly, and we will illustrate you how our active stance and our quality process have been adhered to throughout this very, very volatile year that we've seen. And we are very excited about some of the new positions we were able to bring into the portfolio over the last 3 months in particular. So there's the return again of the strategy, which you've seen in the graph. You can see there over the last 5 years, very close to the index, a very, very concentrated market over the last 5 years, as I've been saying. And during that 5 years, a lot of changes in the portfolio where we were patient with a lot of quality businesses on our 120 universe, and where we feel very comfortable that if we remain patient, that we will get exposure to markets when it fits our valuation criteria. We are quality investors, and we want to own great businesses when they offer us upside to the intrinsic value. We will show you some graphs that will show you that you've got to be careful when you're buying into some sectors in particular right now, valuation-wise. It's been another year where the market didn't really care too much about what we're paying for quality businesses, although we're starting to see some very interesting signs in the market that valuation's starting to matter again. And that's been a very good sort of recent period for us, where we could see the market starting to distinguish between things that are too expensive and things that offer value, even though they're also of a high quality. So when we look at the year and we look at some of the new positions we've initiated, it's been a classic case of the market driving not our decision making, but certainly, we were very carefully watching our universe of names. And back in March, we took 3 significant new positions: Accenture, Heineken, and SAP. As it turns out, all of them were exited after an average gain of 30%. And I just want to again highlight the phenomenon to you that if you look at the market return over the last 3 years, it only has been 30%. So we are in a lower return environment. But if you can compound over 12 years at 8.5 versus 6.5, you end up with a significant, nominal outperformance of 60% over that period, over 100% if you look at it in sterling terms. And that's what we're after, is we don't aim and we don't aspire to any specific turnover target. And Hannah will give you all those details upon request. But it has been a year where we had to be more active than the normal, simply because the market's been extremely volatile and offered some excellent entry positions. For names like Novartis, Becton Dickinson, Alibaba, and AbbVie and Electronic Arts, we still own those positions in the fund. AbbVie and in particular has already delivered for us some decent returns. And certainly Novartis and Becton is offering us, along with Alibaba, for very specific short-term concerns, which are always overblown for a high-quality business, some very good entry points, and the same for Electronic Arts. In terms of position increases, we just highlight that yellow block for you. Names like General Dynamics is very much an example, just like Intercontinental, of a company that was sort of in the face of very bad news, travel-related news. They've been struggling all year, and yet when the vaccine news on the 6th of November came out, and we have some very good data points again today with the UK authorizing the Pfizer vaccine, a name like Bookings was up 30% for us in November, and testimony to our thesis that we are long-term investors and we're looking ahead to what should be a recovery by 2022/2023, where we think certainly by mid-2023 travel industry as a whole would be at a higher level economic activity-wise than where we were at the end of 2019. And we certainly can't wait to see all our investors eye to eye and not over Zoom video going forward. In terms of position decreases, all of those names you see there on the right column Samsung is up 61% since we invested in that name first time in February of 18. It's been a terrific performer now for us the last few months. The DRAM market's very strong. The same with Tencent. Tencent's been a fantastic performer for us since we first invested 4 years ago, but we have been trimming that. And instead, we've been buying into names like Alibaba in particular, where we suddenly see a big sort of valuation discount for Alibaba versus Tencent, even though the growth for Alibaba is probably going to be stronger. So a very volatile market. We also, after very good experience on Alphabet over 6 years and Facebook over the last 2.5 years, we've just trimmed that positions. They are hitting new all-time highs. Certainly in the case of Alphabet, and a classic example of how we operate as value investors. We want to buy these great businesses when they are on sale. They were certainly on sale 6 years ago. They're not on sale at the moment, but we're going to stick with them at a lower position size as they perform for us. Just a quick snapshot of our top holdings. I want to highlight in particular some new names on there. This year, Becton Dickinson and Novartis would be an example of that. Becton Dickinson complements our position in Medtronic, which has been a long-term position for us, which we have reduced on the back of Becton actually trading at a discount to Medtronic, perhaps for the same or not slightly better organic growth. And then a new name like Alibaba is probably worth mentioning. I think the negative news flow around the subsidiary and financial and the sort of catastrophic view that in the short term that the Chinese authority took around some regulatory requirements going forward for Ant Financial. I think it's quite overblown. Some of those long-term concerns, we see terrific growth opportunities for Alibaba, and we've built this up to a decent position size now. If it gets to about $250 US, we'll probably look to increase that. We think that at $60 billion of cash on the balance sheet as well, it's a very good example of secular growth available on about a 4.5% free cash flow yield 1 year forward. With $60 billion of cash on the balance sheet, it's the sort of name we want to own long term for our investors to compound returns for us. Maybe you want to talk about the attribution, Hannah?
Oh, you can go.
Okay. I mean, you will see there just the disparity in returns. And unfortunately, we don't like to talk about things we don't own, but it's worth mentioning just the impact. If you think about the market being up about 10% in US dollars this year, and 20% of that return came from one name. I mean, you're not talking about a small index, you're talking about 2,700 names. The concentration risk and the absolute concentration of some stocks in global equities have never, ever been higher. It does remind me of late 1989 when Japan was 40% of the world and everybody thought that it's worth owning Japanese equities at 70 times earnings. Things do go from one extreme to another. And Apple and Amazon are great businesses, and they are high quality businesses on our watch list and on our universe, but we don't want to own them at this stage. We made fantastic returns from the likes of Tencent, Facebook, and Alphabet this year. We made amazing returns from Samsung, far outperforming the market now over the 3 years we've owned it, and yet Samsung was trading at very attractive low valuations, as low as below book value, although that's not the main valuation tool at all that we use. Is of course it's return on equity combined with a significant and growing free cash flow yield. That's what we're after. And then very importantly, Heineken. I looked at the return of Heineken since we first invested in Samsung about 3 years ago. Your total return in Heineken's only been 5%. And yet, over the course of a 6 or 7 month holding period for Heineken, we made 25% in the stock based on a massive sell-off back in March. It happened to be the low on the 17th of March where we were building the bulk of our position. We kept adding to it. But then the vaccine news came and a lot of the intrinsic value upside was completely taken out. At an intrinsic value of 92, we exited at 94. The stock's drifting back to 89. We think the easy money's been made in that name, and it just shows you can get amazing returns from well-run, high-quality businesses when you enter those positions at the right time, when the intrinsic value is clearly above the market value, but we will exit positions, and we're hopeful that some of the names that have hurt us, like Sabre and Bayer, will continue to recover. I think Tesla's worth mentioning as well. Clearly, you've got to ask yourself about the impact of indexation and what influence a stock has when it comes in at a market cap of 550 billion, which it will do pretty soon. I think it's over the next week it will come in, and there's a furious buying of a name which is trading probably at 100 times free cash flow. We certainly prefer some other names where the valuation makes more sense to us. We had this slide in a couple of weeks ago, and I didn't actually know that the COVID news or the vaccine news is going to come in, but there you can see, again, I just want to illustrate that a long-term investor like ourselves, when we own a name like Booking Holdings, and we were pretty depressed about this only 21 or 22 trading days ago, it just shows you how quickly the world can change. And from our perspective, having rallied 30%, we just marginally trimmed bookings now, but it's actually turning out to be a great winner for us, having added to that position as well throughout our journey over the last 3 years with this name. $5 billion of cash on the balance sheet. They're going to come out even stronger position than before as weak players fall away. And names like Expedia, which is not in the same league in terms of quality, suffer on a relative basis with exposure to traffic. But we are great believers that in the long term, if we can compound returns for you without listening to short-term news, withstanding the fact that it was very overwhelming a couple of months ago, that is what we do as investors. We have to be focused on the fundamentals and not get swept away by the emotional side. I just wanted to highlight again to you that the dynamics over the last 3 years and how narrow the market has become. I've got the Apple return there for you over the last 3 odd years. This was in the beginning of the month, it's probably now even higher, but the first line shows you Apple's return of 185%. Global equities did only 13% total return over that period. And outside of the US, that MXEAW index, that's MSCI Europe, Asia, Far East, so everything outside the US, giving you negative returns over 3 years. And the S&P being the only game in town. I did put this down in my commentary, as I said, 85% of the world's total return came from the last 3 years. Over the last 5 years, we've been in line with a market that's very narrow. We're very excited where we are positioned today, and we believe we can continue to compound returns as we actively manage this portfolio. This was updated this morning by Hannah. You can just see, do you want to box us into a certain corner? Are we growth investors? Aren't we value investors? Well, we categorically state to you again today here, we are high quality investors. We buy great businesses, but we don't want to overpay. So if at points in time we own stocks in the growth sector, or whether we own stocks in the value sector, what I will say to you around this graph is that growth is expensive today. It's very clear from that. It's a fact. I mean, it's not a fiction. And we have, on balance, been selling down names like Alphabet, Facebook, but we've also been selling in the value sector names like Heineken and Diageo. So it all depends on the upside to our intrinsic value. We're not obsessed with whether the stocks are in growth or value. We're obsessed with whether they are high quality businesses that have an economic moat that can be maintained for decades at a high return on equity. So an interesting chart to look at. I think if you look at growth sectors and growth managers, it's fair to say that a lot of outright growth managers, their portfolios are trading at very high multiples today, and we're trying to avoid that.
I think it's interesting to note as well. I was talking to one of my colleagues just the other day, and he said to me, Hannah, value isn't cheap either anymore. Right? It's on 19 times PE. So it's really interesting when you're looking at. I spend a lot of time talking to our risk department about various factors And you're looking at the growth index, which has got the likes of Tesla and Amazon on a 35 times PE. And the quality index is on a similar PE to the MSCI World. But then what you're not taking into account there is the fact that just between two names, Apple and Microsoft, you've got more than 11% of the index. So it's become incredibly concentrated. But if you look at what's led the way so far this year, if you look back to 31st of March, you've got growth has far outperformed both quality and value, and quality has actually underperformed your main MSCI World, because we've had this tremendous sort of rotation has come around as a result of the vaccine news. And we started to see signs of things changing, didn't we, around the 2nd of September, wasn't it, when those growth names started to come down a bit. And that's a problem when you've got such concentrated indexes. If the likes of Apple or Amazon start to not move, then that underperformance becomes very apparent very quickly. And so you started to see us on a relative basis. We really started to pick up in that sense. And then when you've had this month, it's been tremendous because reversal, because you've suddenly seen value come back. And we were looking at the attribution yesterday for last month, and not holding financials and energies cost us over 2% of relative performance last month. But they're parts of the index. We're just when we're looking at our quality metrics that we apply to our stocks, they're not parts of the index we would want to own. But also, when you look at the fact that we are valuation conscious in how we apply our investment principles, we did actually manage, during the month, and it's a tremendously strong month, and we still managed to return, was it about 10% in dollars over the course of the month in our core strategy, because those names that were trading at excessively, or very stretched valuations simply didn't participate in that uplift you had from value rallying, as much as stocks like Heineken, like Anheuser-Busch, like Diageo, which we saw sort of 20-30% moves in over the course of the month. And that goes back to what Peter was saying about how we've been so active. So the whole way through this, it's been very, very interesting how quality has actually, despite this huge holding in the likes of Apple and Microsoft, which are, characteristically perceived as growth and are arguably, has actually underperformed the last sort of near on 9 months already. And how value has now started to stage a bit of a comeback. So I guess we'll just see from here what continues.
Yeah, no, thank you, Hannah. And so very importantly, we want valuable stocks. We want to own those stocks that are in value for us, but certainly, we'd rather make 30% in Heineken based on fundamentals than try and call the bottom in energy and financials. Thank you for pointing that out, Hannah, because staying away from those sectors have certainly benefited us tremendously over time. We are not deep value investors trying to bottom fish in inferior assets. Instead, what we want to do is to own something like Alibaba. So we're going to run quickly through, very quickly, 1 minute at a time, just through some stock examples. If you look at this valuation parameter for Alibaba, and we prefer free cash flow yield, but I've put down there for you a 2-year forward price earnings ratio. Why 2 years? Because that takes out the noise of short-term earnings disappointment in a pandemic-driven environment. Although, of course, Alibaba is actually a beneficiary of the pandemic, not a victim of it. But it does remind me of the graph of Google when we first invested 6 years ago, until the point where the valuation started to blow out. As Hannah said, by the 2nd of September, that was a short-term high in the S&P, and a lot of growthy names came back at a time when we were cutting back on our Googles and our Facebook a little bit. But you can see here, Alibaba, clearly there are a lot of noise now around the Ant Financial IPO, but we think this is a long-term opportunity, especially as we've been reducing our exposures to things like Tencent, Facebook and Google, and Microsoft we've not been adding to, but we've had that for over a decade. Instead, we think that Alibaba is now a very interesting idea, and at a discount as a secular growth company with, as I said, $60 billion of cash on the balance sheet. Here's just the example we did this morning. We just show you the blue line just shows you that Alibaba is close to a 30% discount to Tencent, when arguably their revenues and their cash flows are growing stronger. We still have a position of about 2.5% for Tencent. We were aggressively reducing that position above 600 Hong Kong dollars. Trading at close to fair value now, around 550. It's been a fantastic performer for us this year, also in the past. But a name like Alibaba is now preferred versus Tencent, given the discount it's trading at. Now, this is where active management and being focused on high quality businesses in a ruthless manner is probably very good discussion for us, just to compare two very disparate businesses against each other. In the case of Heineken, I don't think Heineken and Electronic Arts can be more different to where we actually are in terms of what they do. But we now own only one brewing business in ABI. We've kept that position for us. But what this graph is telling you is when we entered the position back in March, April, you can see that Heineken traded at a 20% discount to Electronic Arts. Very different businesses, of course, but the businesses that got affected prominently by the bad pandemic news clearly started to collapse, and we took a long-term view in Heineken. Now, when you look at the chart, you look at the red bar, and you look at November, the beginning of November 20, you see that massive spike upwards. That's when the vaccine news came out. And you had an unbelievable relative move between these two names, where suddenly a company like Electronic Arts came out with results which was a little bit softer than what the market expected. But the ongoing secular growth opportunities for that business and some of the brands that they own, like FIFA and NFL, I mean, those are fantastic brands, and they have a fantastic balance sheet. And suddenly we were at a position where Heineken re-rated by 45% in the space of 6 months. And we saw upside in Electronic Arts. We built a position around $118. The position's now, the company's trading at about $127, very early days. But it's a fantastic example of how our universe of 120 names give us these opportunities, and we carefully watch that. It's covered by Shiraz. He's talking a lot to myself because I'm covering Google. Louis covering NetEase and Tencent. So there are, of course, overlays with mobile gaming in between those businesses. In the case of Heineken, that was covered by Louis, and Shiraz still covers ABI. So this is a fantastic example for us for how we've locked in returns and now get exposure to a different part of the world markets through Electronic Arts. It means we've got an overweight position now in the communication sector again, and we've reduced our position in the staples quite aggressively. So I hope that gives you a good flavor for where we are positioned in our high quality core strategy. I'm going to let Hannah talk a little bit about our Sharia fund to you. We're very excited about this. It's very, very important to note that it's an exact carve out of our existing strategy. We pick our stocks from the same universe, and we are very excited about a very strong month in November. It's hopefully an indication of what can be done when you are very active away from the benchmark, which we are. And Hannah's going to take you through our latest thinking on the Sharia Global High Quality Fund.
Thank you, Peter. And like Peter said, there's the same philosophy and process applies across both funds. One just has a Sharia overlay. So when Peter's talking about how we're adding to Alibaba because of the financial news given the weakness, and we're doing that across both funds, just like when we talk about how we built a position in Samsung and it's done tremendously well for us. They're both beneficiaries of the same process, the same stock selection. So I'm just going to run through our process here very, very quickly. Those of you who have heard us speak about our process before in the Global High Quality Fund, it is exactly the same. We just have this Sharia overlay here. But I just want to talk for 1 second about our reasons behind launching this fund. And the main thing is that we discovered that it's a tremendously underserviced part of the market here. You've got a couple of incumbent funds in the active global equity space that are Sharia compliant. They have all, since the launch of those funds, demonstrably underperformed their indexes, the MSCI World Islamic indexes. And we wanted to try and be able to offer investors, with the backing of our track record, an option to be able to invest in a high quality, actively managed global equity portfolio with this Sharia overlay. We also found that a lot of investors that were needing Sharia compliant products were tremendously under-diversified also as a result of, in their portfolios as a whole, as a result of their not being enough products available. So they find themselves very, very highly invested in property, for example, because they didn't have that optionality of other products out there. So, you know, when there's underperforming funds and when there's a prevalence for index trackers, for example, there's an opportunity here for us to be able to offer clients that what we also think is a very good fee structure, because these active funds, when you have the addition of Sharia boards and so forth, can start charging very extensive fees. We wanted to be able to offer investors access to our strategy, a high quality portfolio of businesses. We still believe that a Sharia compliant investment must still be a good investment and must still adhere to our process. So that was the thinking behind when we started working on this nearly 3 years ago now. So when we look at our investment process, like I said, it's exactly the same. We're screening down across a global universe. We can go anywhere in the world to look for ideas, and Peter's going to talk actually later about some really exciting initiatives we've got going at the minute, looking at stocks in India, for example, just as one example there. So we love the fact that we can go anywhere in the world, and we can leverage off also Sanlam's other teams for research and so forth, such as our emerging market team there, which gives us access to CFOs, to conferences and so forth, allows us another springboard for ideas and cross-referencing. So we do our Sharia overlay. We have a fantastic Sharia board in place called Amani Advisors. They are based internationally, but head offices are in Dubai. They have a very, very highly regarded panel of Sharia scholars that give us the very important fatwa certifications, the evidence that this fund is Sharia compliant. And you do find a lot of funds out there that are purporting to follow Sharia principles, but do not actually have the certifications that Islamic investors who want to truly follow that compliance and give it the credibility, they don't have that in place. So we're very pleased to have that in place, and we're very pleased to have such a well-recognized board helping us and ensuring our compliance at all times. So in the same sense that that the other fund does, we screen down our watch list based on our quality metrics, and then we apply our valuation principles, and Peter, with the help of the rest of the team, will construct the portfolio. It's high conviction, 20 to 35 names. Typical position sizes ranging between 3 to 6%. And as with our core strategy, the same principles apply. And what we found also when we were doing research into how to build this fund was there are a lot of overlaps between the typical screening that we do from a quality basis and Sharia principles. And so what I want to draw your attention to is the balance sheet aspect of it. Because in order for a company to be Sharia compliant, it cannot hold over amounts of debt on the balance sheet. And that's something that's really crucial to us here as well when we're looking at our businesses. So you won't find financial services businesses in our portfolio. You're not going to find highly indebted businesses, but also in the same sense that we're following our normal criteria. You're not going to find businesses with high capital expenditure, but you will find businesses with strong sustainable operating margins, high ROE, low capital expenditure, high barriers to entry, and a moat that is consistent and growing. So what is Sharia investing? We look at the core principles here, which are you cannot invest in a company that has more than 5% of its revenues from prohibited sources, which include pork, tobacco, alcohol, gambling, defense. And then you have the financial screening as well, which is there listed. But the most common one that everyone seems to know is you cannot hold that debt as a portion of your total assets. And I would like to note that we do use the MSCI methodology there in our financial ratios, not the Dow Jones methodology, which can be it can prove to be a sticking point for certain Sharia compliant investors. So I think we can talk about, and maybe Peter can do this, some of the changes we've had in the portfolio. In the same way that we have with the other fund, we have been quite active recently, but we have seen tremendous moves in some of our names, which we will go on to later in the presentation. But you can see there the likes of Alibaba, Samsung, Johnson & Johnson, all features core holdings in our other strategy. And what I really want to reiterate here, whilst everything in our Sharia portfolio is already in our watch list for our global high quality portfolio, if it isn't already included in the fund. So when we did our research historically, we found that over 2/3 on average of our global high quality portfolio was already Sharia compliant. And so what we do when the rest of that, with the other part of the portfolio that isn't Sharia compliant, we can then backfill that with other ideas that are on our watch list that are Sharia compliant. And that may be, you know, for example, something like Cow or Shiseido, for example, they're Edwards Life Sciences that we would definitely invest in as part of our global high quality fund, but it may not be in there at the time because we have other positions such as Becton Dickinson, for example. We don't want to increase that healthcare exposure too much, Peter.
Yeah, no, thank you very much, Hannah. So, I mean, Edward Life's a great example of a company we've owned before in our main strategy. It had a little bit of it's a very, very focused business, a transaortic valve replacement market covered by Louis. It came into value around $75, $76. We invested in it. At the same time, we were reducing Medtronic, not just for our main strategy, but also for this Sharia fund slightly at the time, having moved from sort of mid-80s to 111, 115 odd dollars. So very consistent way of doing things. We're very excited about the opportunity we're seeing in a name like Alibaba as well. And then position decrease is called Tiva, is a company we've also covered because Bayer Corporation is on our main strategy, and that one's the #2 crop science business in the world. So that's been a natural position for us to take. It's done significantly well for us, 30% since we first invested. So we've trimmed that a little bit. And EssilorLuxottica, they have the Ray-Ban brand, for instance, covered by Louis. He also covers Kering in the luxury space, so a name that could have made it onto our main strategy as well, but we already have significant consumer discretionary exposure through bookings to Continental and Yum brands, and therefore it just wasn't in there. Unfortunately, those businesses can't make it onto the Sharia screen, so we've substituted it for Essilor. It's been a terrific investment for us. We've actually formally exited that position yesterday after another 25% rally. So there you see the top positions, a lot of overlap with our existing strategy. A name like Philips is worth mentioning, covered by William. It is a name that could make it onto our main strategy as well, but because they are transitioning to a fully fledged medical equipment business, as Hannah mentioned, we've got Becton Dickinson already on there in our main strategy. So Philips is really one that replaces Becton, trading at very similar valuation, very similar high quality businesses. And this is how we can dynamically have names in our portfolios that fit both profiles. You can also see there that if we look at a name like Cow Corp, as Hannah says, it's a very highly focused, very ESG focused business as well. They want to be completely carbon neutral by 2030. They're focusing exclusively on the Chinese market as their main sort of growth area, along with parts of the US, interesting enough. And they feel they can replicate their margins over time that they enjoy in Japan, also in a market like Indonesia, China, where they've got great focus and where their products are quite high end, along with their competitor Shiseido. So this is just give you an idea of some of the vicious moves we've seen, even though we've only done this now for 2 months. So Taylor Wimpey, a high quality home builder in the UK, very much out of favor because of what's happened with COVID. We saw it as an opportunity. Great example of where we use our UK colleagues for their input as well. As the head of global equities, I have access to the UK team and the emerging market team. I've used that to my advantage. We can talk a little bit about HCL technologies in a moment. But it shows you that we've enjoyed some of the returns, but we've also had in our main strategy. You can see how Samsung has delivered a strong return in a very short period of time over the last 2 months. And then we've used that weakness in names like SAP and Alibaba to add to our positions, and Roche, in fact, which has just underperformed over that period, but where we very confident Roche has been a position for us in our main strategy for over 5 years. So looking at pharmaceuticals in particular, healthcare is a big exposure for us in this actually strategy. So you can see they're very attractive valuations. It has derated significantly over the last 5 years from 16 times to about 12 times earnings on a 2-year forward basis. You can see that little spike upwards towards the end. That's probably because the market became more comfortable that Biden won't control the Senate in the US and won't be pushing through draconian measures for the healthcare industry. And that's what we believe is a long-term opportunity for the sector to re-rate over time. And Novartis is a good example. It's trading at the low 80s. We think it's worth 170. Sorry, apologies. I wish it was 170. It's 107 Swiss francs intrinsic value. And this is a business we've been watching for 10 years. We first initiated this in our main strategy in May, and it also finds its way naturally into the Sharia compliant fund as well. I've thrown you some examples of just how volatile this market has become. Inditex, the owner of the Zara brand, which might be familiar to you, very good integrated business, enjoying significant free cash flow. They've got a great balance sheet, family controlled, of course, by one of the richest people in the world. But you saw how that company, having traded at a discount of 15% against a high quality business like SAP, back in August, September when we launched the strategy, now trading at a 20% premium, and therefore we've exited this position. It hit our intrinsic value, and we're moving more of our money into SAP. They've had a bit of a reset on their 22-23 targets, but we think it's a long-term opportunity to build a position in SAP again, a business we've owned on and off for the last sort of 7 years. And then finally, just I want to talk about HCL Technologies. As Hannah said, the corporate cooperation and the integration of our teams on a research basis only. I have access to 3 analysts in the emerging market team that sits down in South Africa. They travel all over the world covering names like HCL, which is part of their portfolio. Hannah, on the screening process, discovered this name. They set up a call with me with the CFO. I found him very, very convincing, very impressive. I like the fact that he thinks he's got a conservative balance sheet. Aggressive balance sheet when you've got $2 billion of net cash on a market cap of 10 billion. That sort of music to my ears as an investor that's pedantic about valuation. So we find a business like this, and if we compare it against Heineken, which we sold for our main strategy, you can see there by the time that we exited Heineken, that Heineken moved to only a 15% discount at the top there at the end of October, middle of November, against HCL, which we believe is actually a much faster grower. We don't understand why HCL should trade at a 30% discount to a name like Heineken. You can see that Heineken, as the gray chart, has just the valuation has just moved up. In fact, back to a higher level than where we were at any point during the last 3 years. So significant earnings recovery has already been discounted for Heineken, whereas for HCL, we find that the terrific fundamentals, and the CFO is very focused on the 3 verticals, and all of them are growing very fast, digital in particular. But you're just looking at the fundamentals of this business, you can see the consistency of the high return on equity, the very high return on assets, the return on capital. Everything's looking very, very good for this business. Operating margins high. We sold Cognizant in our main strategy. HCL is also in information technology services, but we think the verticals that they address and their exposure on an industry level is better than Cognizant, yet we're getting that at a discount. It might be that investors perhaps not familiar with these interesting businesses in India. We think that could be a long-term opportunity for us to invest in high quality businesses like this, run by very, very capable, if not excellent management teams. As far as I'm concerned after my meeting with the CFO. So thank you very much for your time. We're going to do the stock shares. You'll have to look at our faces again. So if there are any questions, please feel free to ask them. We're just going to go into the chat to see if there are any.
Yeah, thanks, Hannah. Thanks, Peter. As I mentioned when we started, we were a little bit short on time. We do have a minute or two for questions. If there aren't any questions that come through on the Q&A, I see there are one or two that have come already, but if there are any further questions, you're welcome to email me, and then we can relay those on to Peter and Hannah, and we can respond to you. But absent sufficient time to answer the questions right now, Peter and Hannah, I want to thank you very much. Just a question from my side. Hannah, what is the response being like in respect to the launch of the Sharia compliant fund? I know that you were at the listing on the London Stock Exchange. What has the general market reception been like?
Thanks, Mark. It's actually been phenomenal. So the fund's been launched for just over a month now, and we've got $10 million in already, but we've got a fantastic pipeline from places such as the Middle East, Canada, for example. We've had an institutional investor from the UK. So like I said, it is a very underserviced market on the Islamic compliance side, but we're also getting a lot of interest just from the fact that it is another way just to access a high quality global equity strategy. We're getting a lot of reception from ESG conscious investors as well, who may also want to invest in our core strategy but have views on things like tobacco stocks. We don't hold energy financials and so forth as well. So, it does screen well from that aspect too. There is a lot of overlap, which I'd be happy to go into offline. So, no, we're very pleased that we have had, tremendous reception, and we do have a lot of conversations ongoing. So we're very hopeful to be able to serve investors well with the fund. And it's, we've had a tremendous month with it. It's up sort of nearly 12% in dollars last month. Despite energy, which is a huge part of the sector, having a substantial rally of 30+%, which would have detracted 4% of performance. So, through these big names, these big moves we've done very well. And,
we're very happy that, you can demonstrate that you can ignore large parts of the market that doesn't fit our quality criteria and still have a great month for stock picking. It has been exceptional. We don't know if we can always repeat that, but we're very, very excited about the quality that companies we can own and their long-term ability to outperform the index over time.
Okay, well, great. Just by way of just a signing off, for those investors who are, as I mentioned, dialing in from 9 different countries, you do have your relationships held in country. There's a number of them, and can get further information on the Sharia compliant fund or the global high quality fund from them. Alternatively, you're welcome to get in touch with me directly, and then we can flick it on to Peter and Hannah. Just also a further heads up, the moment that we are able to travel, we will be traveling with Peter and Hannah to some of the places we visited before. Nairobi, we've spoken about India, and other places we'd love to come and meet potential investors as well. So Peter and Hannah, from our side, from Mauritius, thank you very much. We look forward to speaking to you again. Thank you very much, everyone, for joining us today. Appreciate the attendance. Just one last housekeeping note that I've just been advised to mention is that this has been recorded and will be on our YouTube channel for those who want to view it again. All right, well, with that, thank you very much and appreciate your time.